Our next guest sees something ominous forming in the market, and it may be time to hit the sell button. Let's bring in Savita Subramanian, head of U.S. Equity and Quantitative Strategy at Bank of America BofA Securities. Savita, great to see you.
Great to see you, Melissa. Great to see everyone.
So we've just been outlining sort of these baskets of stocks we think are going to be leadership next year. Which sorts of baskets would you lean towards?
Look, I think there's always money to be made by investing in equities. And I think the best bang for your buck in this type of market is playing a cyclical recovery rather than a stock market recovery and looking for basically the most GDP sensitive stocks in the S&P 500. So that really gets us towards financials. Even energy is a sector that I think could continue to work in an environment where we're all coming, we're emerging from our cocoons, probably more of a second half story, admittedly, but I think the market is anticipating that. My highest conviction idea for you right now is value, value, value. And it might be just as simple as looking at the 50 cheapest stocks in the S&P 500 by price to book value or price to earnings. Here's the kicker. In every recession that we've had, in 14 of the last 14 recessions, we've had the recovery led by cheap stocks. And that recovery has typically lasted for about 12 months. That value cycle has lasted for 12 months. So I think that everybody is looking at what's happened over the last few months. We've had a great run for energy. We've had small caps come back from the dead. We've had, a lot of these cheap, beaten down areas of the market, starting to outperform. People look at that and they say, this is done. You want to go back to growth stocks. And I vehemently disagree. I like the new thing that I just heard about in the last segment, because I think it makes sense to switch from growth stocks with tough comps to value stocks, which are actually the new growth stocks. I think what's really interesting right now, Melissa, is that if you look at the value benchmark, it is slated to grow earnings faster in the next 3 years than the so-called growth stocks and the growth benchmark. This is a weird world we're living in, but I think it's typical of coming out of a recession.
Hey, Savita, it's Tim. As always, it's great to have you on the show. And when you talk about value, and this is a little bit more of a tactical question, is it value on a trailing basis or a going forward basis? Because, on a trailing basis, it's obviously we're looking back at normalized earnings. And there are a lot of these companies that people don't expect to normalize until 2022. Do you have a thought on that?
Yeah, I do. I have a lot of thoughts on that. Great question. I think that value is really it's less about a snapshot multiple, and it's more about kind of a DCF way to think about the world. And even if you look at growth stocks versus value stocks on a discounted cash flow analysis, and I can send you the numbers and the backstory here, we found that value stocks are now finally cheaper than growth stocks. It's interesting because I think the growth companies did really well for a really long time because interest rates were falling to zero. And that low cost of capital helps these, growthier, long duration types of stocks. But we're now at a point where even factoring in this ultimate low interest rate environment, growth stocks are now starting to overprice that discount rate. And I know this is a little too mathy, but I think that we're at a point where if anything happens to the discount rate, if rates rise even a little bit, and we've seen a pretty big move so far, if we see any sort of inflationary pressure in the economy, that's really going to hit a lot of these growth companies from a DCF or a discounted cash flow basis harder. So, your question is well taken. How do you value companies in today's low interest rate environment? And I think a discounted cash flow kind of analysis is the only way to think about factoring that in, if that makes sense.
Thank you.
So I really appreciate that you like my new FAANG sort of category that I've created and thrown some of those names out. Are you concerned? I have a little bit of concern, but I'm curious because of what you said also. We got a lot of names in there that have pretty high valuations, relatively speaking. So does that concern you at all about the new FAANG?
I think that, like I said, valuations are a little bit sort of screwy right now because, when you're at a peak or a trough in the cycle, the worst way to pick stocks is on a price to trailing earnings, right? I mean, you don't want to look at that because that's going to guide you exactly to the wrong stuff. So I think that, kind of looking at companies more holistically and thinking about, how much are you paying today for the future of their cash over the full cycle at current discount rates? That's the way to think about it. And, when I look at financials, which I think you named as the F in FANG, financials is a sector that actually looks very attractive on a DCF perspective. It's also a beneficiary of potential inflationary pressures. It's a beneficiary of a recovery. It's got quality balance sheets. I think that's a sector where it's easier to say, okay, it's cheap, but it's cheap for good reasons rather than bad reasons. In other cases, when you look at the market, there's a lot of areas that have already grown expensive on trailing earnings, but I think that trailing earnings right now are just way too low if you think about what we're moving into in 2021, which is a grand reopening of the economy coming from an unprecedented global shutdown in economic activity. So I think those are some of the
Savita,
factors.
always great to see you. Thank you so much.
Great to be here. Thanks.
Happy holidays if we don't see you again. Savita Subramanian,
You too.
BofA. James McDonald, I know you're skeptical of the markets. You're still predicting a big pullback. You liked VVU for those reasons. But I know that there's things in the markets that you are invested in. So where do you find value right now?
It's a great question. What we want to do is understand things are going to depend on how this vaccine works. If the vaccine works, we wanted to talk about casinos. We think they stand to benefit the most from a vaccine rollout. If the vaccine works and the fear comes off, people are going to rush back into those things that they rushed out of, right? And so we're talking about hospitality. We're talking about casinos. We're talking about these areas that saw the immediate shock. Airlines, obviously. These are areas that we think we can buy cheap and make money on going forward, depending on the efficacy of the vaccine, which we're about to find out right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.